Yeah, so we can end up having to begin so that we can be able to cover something substantial here. So there's a computation which I need to be able to clarify as per today's computations. I think I had done a computation for goodwill, we had done NCI, and we had done retained earnings. So we finalized by having to look at the investment in associates, the investment in associates, the investment in associates. So you can be able to correct that particular computation. So you'll take the purchase consideration, you'll take the purchase consideration, which in this case was actually, in this case, 500. So our shillings are in millions, exactly 500. Then you'll add the post-acquisition changes in the net assets, So the net asset in this case that you'll be able to consider will likely be the retained earnings, retained earnings. So retained earnings for the year, for this particular associate, it was actually in this case 200. It is 200 million. But of course, in this case, it existed for only 3 months. So you will take 3 months, multiply by the 200 million. But now you only take, in this case, what, 40% of it. So if you do this, you'll likely be able to end up having to get, I think, 20. So in total, in this case, the investment in associate will likely be 520, not 550. So we're putting here 500. It's supposed to be 200. So the post-acquisition retained earnings of this particular associates, you take 3 months, because it existed for only 3 months, by the 200, which is the retained earnings for the entire year. The retained earnings for the entire year, then you multiply by 40%. Because we have a significant influence of 40%, you'll be able to get, in this case, 20. You'll likely end up having to get, in this case, 20 like that. So 20, 20, 20, 20. Yeah. So that's it. Then in this case, you should be able to place this one in the statement of financial position. It should be able to balance. So that is the computation for what? For the investment in associates. So hope you've been able to get that. So I want us now, in this case, we switch gears today. Of course, we'll come back to group. But let's try, in this case, to start looking at the revision of published financial statements. We have, in this case, published financial statements. And in this case, in the meantime, you can actually be trying to get this particular question here as I try to explain something here. So get this particular question here, November 2016, question number 2. So get this particular question as I try to explain something here. November 2016, question number 2. So when you're preparing the published financial statements, there are certain areas we laid emphasis on. So for example, under, in this case, published financial statements, the most commonest questions that will end up having to be tested in this case, they'll actually call upon you to prepare a statement. Of profit or loss. Sometimes we refer to it as what? As the income statement. They can end up having to call upon you to prepare the statement of changes in equity. Statement of changes in equity. And of course, also they can actually end up having to call upon you to prepare a statement of financial position. Or they can actually call upon you to prepare a statement of cash flows. They can call upon you to prepare the statement of cash flows. So the most commonest are these two. To some extent, they might bring in this one, or they might end up having to test this one independently. When they test this one, they end up having to test it independently without having to include these ones to be tested there. So they can call upon you in this case to prepare a statement of profit or loss, a statement of changes in equity, a statement of financial position, or maybe a statement of what of cash flows. So of course, with regards to the statement of profit and loss, we said in this case, there are certain expenses that you actually end up having to combine them. So just like in this case, key elements regarding what the statement of profit or loss. So the key computations you'll be able to undertake under the statement of profit or loss, under the statement of profit or loss, the key computations you'll end up having to undertake, you must ascertain in this case the cost of sales, you must ascertain in this case the cost of sales as a combined figure. The cost of sales as a combined figure. You must also in this case be able to ascertain the administration expenses as a combined figure. We have in this case what? We can have selling and distribution expenses. Then in this case, we can be able to have also in this case what? The finance cost. We can have the finance cost. So most of the expenses regarding in this case, the statement of profit or loss will likely basically end up having to fall amongst these what categories, these categories. So it means for a statement of profit or loss for a published financial statement, you don't end up having to split. For example, here you go there, you start saying opening stock plus purchases plus minus what? Minus closing. No, you don't do that. This one you do as a working separately. Then when you are preparing now the statement itself, you plug in one figure. If you do this like in the exam, this one like this in the exam, you won't end up having to score the mark, you'll get a wrong. So all these ones should actually be computed separately. Then eventually you just plug the figures in the final statement, which you call what? The statement of profit or loss. So quite obviously, the most commonest workings you'll likely be dealing with will likely to ascertain the cost of sales, administrative expenses, selling and distribution expenses, and of course what? Maybe the finance costs. Those are the major like key ones. In this case, you'll end up having to do the computation. When you're having to, in this case, prepare now the statement of financial position. So we have in this case the statement of financial position. Statement of financial position, the common in this case computation you have to ascertain properly. In this case, number one, it is the property, plant, and actually of course what? Equipment. So you normally in this case get it as what? As a combined figure. It is in this case what? The property, plant, and of course now in this case what? Equipment, property, plant, and equipment. There could be other key computations you might end up having to ascertain, or you just need to be very keen about. The other computations you must actually be able to ascertain, or you end up having to be very keen about. So under in this case, the equity part, under the equity part, you might be forced in this case to use this one. Sometimes in the exam, they might call upon you to prepare this one, statements of changes in equity. So the balances you bring under equity, they are the ones in this case that would have actually been computed in what? The statement of changes in equity. So in any case, you haven't been called upon to prepare this one, you might do it, eventually do it as a working. So that in this case, you can get the balances at the end of the year to be able to, in this case, place under equity in the statement of what? Financial position. So this one basically, they can be ascertained in the statement of changes in equity. Statement of changes in equity. So you'll have to get, in this case, they might end up having to tell you maybe the company issued more shares during the year. So they are affecting the ordinary share capital. When they're having to issue these shares, they issued them at a premium. They might end up having to tell you, for example, the company revalued assets, and therefore in this case, it ends up having to create a revaluation reserve. So there's a revaluation gain, which in this case eventually gives rise to what? Revaluation reserve. So that ends up having to be part of what? The equity items. So under the equity items, commonly we'll have ordinary share capital, maybe preference share capital. We might have share premium. We might have reserves. And in this case, also retained earnings. Retained earnings. So those are the commonest that you'll have to adjust here under the statement of changes in equity. So you'll in this case adjust maybe ordinary share capital. There can be a share premium. There can be revaluation reserves. There can be retained earnings. There can be preference share capital. Those are the most commonest that in this case, you have to, in this case, ascertain in the statement of changes in equity. So what you'll be able to get as the balances at the end is what you'll be able to place as the figures under what? The equity element in the statement of financial position, statement of financial position. So there are just other, in this case, also key areas you have to be very keen about in the statement of financial position. So in most of the instances, in the additional information, in most of the instances, in the additional information, they likely end up having to give you, in this case, the closing stock. They'll give you the closing stock. Number two, they'll give you the tax payable, current tax payable. They'll give you current tax payable in the additional information. They'll also, in this case, give you the deferred tax payable. Deferred tax payable. They'll also give you, in this case, what? The deferred tax payable. So in most of the instances, these figures will likely be given in the additional information. And of course, now these ones, they normally appear in the statement of what? Financial position. They normally appear in the statement of what? Financial position. So in this case, it means sometimes you won't do any adjustments on this one. You'll just plug them directly in the statement of what? Financial position. So you'll just plug them directly in the statement of what? Financial position. So the only computation that will be able to arise regarding these two, this particular two, is when, in this case, you want to ascertain the income tax expense. You want to ascertain here the income tax expense. You want to ascertain the income tax expense. It will end up having to comprise of the current tax and either an increase or a decrease in what? In the deferred tax. For now, what you'll be given as additional information, it just means these figures is like you would have already scored the mark. If you place them the way they are, basically in this case, in the statement of financial position, you'll be able to score the mark. The only computation arising from these two is when now you want to ascertain what? The income tax expense, which in this case is normally what? In the statement of what? Income. So you'll use it to be able to calculate here. But now the figures you would have actually been given, they end up having to appear what? In the statement of financial position. This one as a long-term liability, this one as a current liability. Because it is payable, it has not been paid, then it is what? It is a liability. And the deferred tax are basically long-term liabilities. They are long-term liabilities. So that is what you need to be able to be very keen about regarding what? Having to prepare the published financial statement. So we can be able to look at this particular question here. Then we see how you can actually end up having to handle some of the areas in the exam, So hope you've been able to get that question. November 2016, question number 2. So just confirm whether you've been able to get it, because I want us to start on it. And see how you'll end up having to deal with some of the areas in the published financial statements. So I can see Nakesa says, yes, she has gotten the question. What about the rest? The rest you can be able to also confirm whether you've been able to get it. Confirm whether you've been able to get it. I can see Karen Paul says, yes, she has actually been able to get it. So I think we can begin. So November 2016, question number 2. November 2016. November 2016, question number 2. Question number 2. So it says, the following TO balance was extracted from the books of Peak Limited as of 31st of October 2016. So you've actually been given the balances there. We have land, we have buildings, we have plant, we have purchases, we have distribution expenses, we have administrative expenses, we have loan interest paid, we have leased plant, rental, Leased plant rental. So they were having to pay rentals on our leased plants. Then in this case, you have inventory. Inventory, that is opening. We have account receivables. We have account receivables and long-term investments. Then you have, in this case, revenue. We have ordinary share capital. We have income from investment. We have retained earnings. That is at the start of the year. We have 8% debentures. We have a dividend that was actually paid during the year. We have account payables. We have cash in hand. We have cash in hand. We have deferred tax. We have bank overdrafts. We have, in this case, what accumulated depreciation on, in this case, what buildings, and of course, what plant. Then you've actually been given additional information there. So you're told 8% of debentures were issued on 1st of January 2016. Interest is payable 6 months in arrears. So inventory was valued at 259.2 million as of 31st of October. So that is the figure I'm having to tell you. They likely give you the closing inventory at the end of the year. They likely give you the closing inventory at the end of the year. And in most of the instances, this figure doesn't have any form of adjustments. So you can directly place it already, in this case, in what? In the statement of financial position. It won't have any issues. It won't have any issues. So you don't have to really adjust it. But of course, for the other items, you might end up having to adjust them. So that is what you'll be able to place in the statement of financial position as what? As the current asset. On 1st of November 2015, PEC Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st of November 2015, was in this case 132 million. The fair value of the plant is actually 552 million, and the implicit interest rate is actually 10%. So, of course, in this case, the lease was for how many years? 5 years. It was a 5-year lease. So that is what we refer to as what? As a finance lease. So as a finance lease. So under, in this case, leases. So under, in this case, leases, if you can be able to recall very well, under leases. So the first thing we were trying to compute in this case was what? Was the lease liability. Lease liability. Then, of course, also in this case, we were having to ascertain the rights of use of an asset. Right of use of an asset. This right of use of an asset, we were treating it as what? If you can recall, Karen Paul, if you can recall, right of use of an asset. We were treating it as what? We were treating it as what? As an uncurrent asset. As an uncurrent asset. So, as an uncurrent asset. Then in this case, regarding the lease liability, we were trying to come up with what? An amortization schedule. Then along the way, with the amortization schedule, this lease liability, we were able to determine the non-current liability element of it and the current liability element of it. So that means that is what we'll end up having to do regarding this. That information will actually been able to be given there. So we'll ascertain what is the lease liability, the non-current one, and of course the current one. Then of course also you have to know the right of use of this asset. Because it is a finance lease, then in this case eventually, this asset will likely end up having to be recognized as part of what? The non-current assets of this PEC Limited. Because in this case they had done what? Entered into a lease agreement for an item of what? Plant, to be given an item of plant. So it means they should be able to recognize them as part of the assets of what? Or in their financial statements, because it is a financial lease. So we'll be able to see that. Then plant is depreciated at the rate of 15% per annum using the reducing balance method. Depreciation expense is to be included under cost of sales in the income statement. So this is what we said. In this case, you must be able to take note of. Whenever you are told a particular expense goes to the cost of sales, you must be able to add it on the cost of sales. So that in this case, you get the correct figure of cost of sales to be able to place in the comprehensive income statement. Land and buildings were revalued on 1st of November 2015 at 600 million and 1050 million respectively. So when you just hear about assets having to be revalued, you must actually in this case think of what? Revaluation reserve. You must think of revaluation reserve. And of course what? Revaluation gain. revaluation gain. So if they're having to revalued up, they were revaluation gain and a revaluation what? Reserve. Which now in this case, this one ends up having to appear as what? As the equity and equity item. When you hear they're talking about revalued assets, see if there are any reserves, if there are any, in this case, reserves, you'll have to add them with that revaluation. If they were not there, then you have to recognize these reserves in the equity items, and the revaluation gain as what? As other incomes, So the corporate tax for the year ended 31st of October 2016 was estimated at 169.8, and the deferred tax provision as at 31st of October 2016 was in this case 84.6. So that's what I was having to say. So there are those three figures. They'll just basically be comfortably be placed in the statement of financial position without having to do what? Do any computation on them. So like those two figures is what? It is tax payable in terms of what? Deferred tax and of course what? Current tax. You don't have to adjust them. So even if these other adjustments are confusing you, those marks you should be able to score them because you don't do any adjustments on them. You just place them in the statement of what? Financial, because you've already actually been provided for. You've already in this case actually been provided for. So that is what in this case you need to be able to take note of. So we can actually be able to quickly go through a few workings there before you eventually in this case just prepare those what? Financial statements. You can go through a few workings there before in this case we eventually prepare what? The financial statements there. So we can start with the first one. The 8% debentures were issued on 1st of January 2016. So of course, if you look at the statement of the trio balance, you can see 8% debentures of 300 million. So they're having to say, remember the financial statements that we're having to prepare, it is from when? It is from, so the end of the year is actually 31st of October, 2016. It means the start of the year is actually 1st of November 2015. So these debentures, you're having to be told they were issued on 1st of January 2016. So it was on 1st of January 2016. And therefore it means these debentures have actually been in existence since they issued for a period of how many months? 6 months. For a period of 6 months. For a period of 6 months. And therefore it means if you are to compute interests, so interest on these debentures will likely be 8%, You multiply in this case by 300 million. You multiply by 300 million. But now, because it was for half a year, then in this case, you have to do what? Multiply by. So the 8% debentures were issued on 1st of January 20. So it's not 6 months, it is actually 10 months. So from January to this, it's supposed to be 10 months. So it will be 10 out of 12, so that you can be able to get the interest accrued. The interest accrued up to the end of the year. So if you do that computation, so that is how much? You get how much? When you do the computation, you get how much? So 8% multiplied by 300 multiplied by 10 out of 12. It comes to the interest accrued. It comes to 100 and is 160. No. So 8% of 300. The debentures is exactly 300. You multiply by 10 out of 12. It is 20. It's supposed to be 20. Exactly 20. It's supposed to be 20. So this means that is the interest they are supposed to pay. The interest they are supposed to, in this case, do what? Pay on these what? Debentures. So these debentures they sold, they're supposed to pay an interest for the entire year up to the end of the year. How much? 20. They're supposed to, in this case, pay how much? 20. They're supposed to pay 20. They're supposed to pay 20. But now, if you look at the income statements, if you look at the trio balance, sorry. So this basically means is the interest for the entire year. So it will likely basically be under what? The finance cost. Interest is what? The finance cost in the income statement. It will likely be the finance cost in the income statement. But now there was an interest that was actually paid during the year. So in this case, the entire interest on these debentures is actually 20 for the entire year. But there was some interest that was actually paid. There was some interest that was actually paid of 12. There was an interest of 12 which was paid. You can be able to see it on the trio balance. So it means in this case, if they paid 12, they have what? 8, which they haven't yet actually been able to pay, which they haven't yet actually been able to pay. It is actually in the trio balance. There's a loan interest paid. There's a loan interest paid there, which you can actually be able to see there. There's a loan interest paid. There's a loan interest paid of 12. So for the entire year, the interest was supposed to be 20, but ideally they paid 12. So it means by the time you are coming to the end of the year, there's 8 which they are to pay. This one becomes what? Accrued, becomes accrued interest. And therefore, where does it go? So this one basically will be a current liability. It will actually be a current liability. It will be a current liability because it was not actually in this case done what? Settled. It was not actually in this case done what? Settled. It was not actually in this case done what? Settled. So that's basically in this case how you'll actually end up having to deal with that particular kind of what? That kind of an adjustment. So inventory, we have in this case what? The closing inventory, which you've actually in this case been given as what? As 259.2 million. So that closing inventory will actually help us to be able to calculate, it will help us to calculate the cost of sales, because in this case, cost of sales is opening stock plus purchases minus, in this case, what? Closing stock minus closing stock. But of course, the other adjustment on the cost of sales, so we can leave it for now. We can leave it for now because the other adjustments on the cost of sales down here, which you have to, in this case, also do what? Add on the cost of sales. So you'll be able to use it when now, in this case, we are computing that. So we can, in this case, go to our next working there, which is basically note number 3. On 1st of November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st of November 2015, was 132 million. So this one, they were having to pay in what? In advance. Remember, in this case, with the leases, we said that the payments can actually be in arrears, or in this case, they can actually end up having to what? To be in advance. So what is so important in this case, you have to be able to take note how the amortization schedule will actually end up having to look like. If in any case, for example, they're having to deal with what? In advance, or they're dealing with what? In this case, what? Arrears. Then, of course, also in this case, be able to know how you can be able to calculate the lease liability. The lease liability. You can be able to, in this case, calculate what? The lease liability. So the fair value of the plant is actually, in this case, 552 million, and the implicit interest rate is actually 10% per annum. Is actually 10% per annum. 10% per annum. So, of course, you've actually been given the fair value of this lease. You've actually been given the fair value of this lease as 552. But now, the correct way you are supposed to get that fair value is for you to end up having to do what? Compute the lease liability. You need in this case to be able to compute the lease liability. So we can be able to compute the lease liability. We can compute the lease liability on this what? Plant that they ended up having to lease. So in this case, you'll end up having to take the rental payments. You take the rental payments. You take the rental payments that they're having to pay. You multiply in this case by the present value interest factor of annuity. It is for a period of 5 years. It is for a period of 5 years. It is for a period of how many years? 5 years. So of course, the rental payments they're having to pay, it is actually in this case an amount of they're having to pay 132 million. Exactly 132 million. So it will likely be 132 million. We multiply in this case by the PV of an interest rate of what? Of 10. The PV of an interest rate of what? Of 10. So you know how you get the PV from FM. So it will likely in this case be 1 minus 1 plus R raised to, is it negative N over R. So the interest rate is actually 10%. It is 10%. This one is 10%. So try to get that. Try to get that. What are you getting as the PV factor? Remember, it is for 5 years. It is for 5 years. It is for 5 years. So what is the PV factor you're having to get? What is the PV factor you're having to get? I can see 6.1445. I can see 3.7908. So the correct figure should actually be that 3. We're getting 3.7908. 3.7908. If you multiply by 132, what do you get? If you multiply by 132, what do you get? That 3.7908 if you multiply by 132. You're getting 500.38. So 500.38. 500.38. Let me confirm. Yeah, so I think there's something I've noticed. So we are saying it is 5 years. We are saying it is 5 years. So of course, in this case, you're having to be told that these particular leases were having to be paid in what? In advance. They were having to be paid in advance. They were having to be paid in advance. They were having to be paid in advance. So already in this case, at this particular point in time, we're having to do the computation. They have already paid 132. They have already paid 132. And therefore, in this case, the lease payments that are having to remain are actually 4. They're actually 4. So here it will actually be 4 actually. It will be 4. Not in this case 5. Not 5. So because in this case, they're having to make the lease payments in what? In advance. So when they started, at the start of this particular 5-year period, they paid 132. At the start of the period, that was on 1st of, 1st of what? That was on 1st of November. 1st of November 2015. So it means for the next 5 years, so that is 1st of November 2016, they will pay another 132. So it means in this case, our computation here in terms of liability, we need only to be able to consider those lease payments that they are yet to settle. And of course, there'll be 4 of them. There'll be 4 of them. So this one has already been settled. So you won't end up having to consider it under what? Under the lease liability. They have already been able to pay it. So it is no longer what? A liability. So what are remaining installments? They're actually 4. So you'll basically put here 4, not actually 5. So you can be able to correct, put here actually 4, and now do the computation. So Dana, in this case, will be able to give us what is yet to be paid. What is the lease liability? What is the lease liability? So they'll pay 2016, the next year they pay again, 2017, they pay again, 2018, then in this case they pay again, 2019. So we'll only be able to consider this particular four of them because they're having to be paid after a year. This one is no longer, it is not a liability because when they're having to take the lease, they are taking the asset, they have already paid it. So what is remaining is only 4, and of course it will be 1, 2, 3, 4. So you can put here 4, then you now give me the figure. It is 3 points. It is 3 points. It will actually be 3 points. You can now be able to correct it. It's not supposed to be 4 years. The lease liability will actually basically be for 4 years because 132 has already been settled because they're having to pay in advance. In any case, they were having to pay in arrears, then we would have been able to consider all of them because they are paying at the end of the year. So at the end of the first year is when they're having to pay. So it is a liability. But here, they have already settled one of the installments as they commence. So it means in this case, what we still have as liabilities are only what? Make 4 of them. So 1, 2, 3, 4. It will actually be for 4 years. So you'll get 3.16. You get 3.1699. Then now in this case, when you do the 132 by that, by 3.1699, you get 418. So you'll actually end up having to get 418 as the lease liability. You get 418 as the lease liability. So once you have this one, then we need to be able to calculate the right of use of the asset. Right of use of the asset, which we said in this case we will recognize as an non-current asset. So for the right of use of the asset, we said you take the lease liability, which in this case is actually 418 million. Then you add on any advance payment. Add on advance payment on commencement of the lease. Advance payments on commencement of the lease. Advance payment on commencement of the lease. On commencement of the lease. And of course, the advance payment on commencement of the lease is actually 132 because they are paying in advance. So before they commence, they have to pay this 132. So you'll end up having to add it here so that you can be able to get the right of use of the asset. If you add, you'll get 550. You end up having to get 550. 550. So this basically now will be able to appear as what? As the non-current assets. Will appear as the non-current assets in the statement of what? Financial position. Of course, also here you need to be able to remember we said under a lease, in any case, there were any other payments made to facilitate the asset to be put into use, you can also be able to add it here. It will be added to the right of use of the assets. So the right of use of the asset, you take the lease liability, you add on any advance payment on the commencement of the lease, which was in this case, what, 130. That's why we haven't considered it when we are computing the lease liability, because they paid it immediately. You'll only be able to consider for the 4 years. So this is the right of use of the asset, is actually 550. 550. But now, on this particular item, you've been told that it has a useful life of how many years? It has an estimated, this item had an estimated useful life of 5 years. And therefore, in this case, you have to consider the depreciation of this item, each and every year. So we'll have in this case what? Depreciation on the leased plant. Depreciation on the leased plant. On the leased plant, it will actually in this case be 550. We divide by, in this case, by 5. We'll end up having to get 110. So it means for this current year, we have to depreciate that item by 110. So of course, we'll recognize it as an non-current asset, but now we have to consider this depreciation. We have to less it. We have to less it there. So this item had an estimated useful life of 5 years. The annual rental, which was payable in advance with the effect of 1st of November, was actually in this case 132 million. So the fair value of the plant is 552 million, and the implicit interest rate is actually 10% per annum. So of course, there's that figure you've actually been given of 552. So that is basically what used to happen as per the previous requirements of the standard. You would have actually been given the fair value of what? Of the item list. But now, as per the current standard, you have to do the computation by, in this case, multiplying by the PV-FA. You have to, in this case, do what? The computation by multiplying by what? By, in this case, what? The PV-FA. So you have to get, in this case, the present value of these payments they're having to make. That is as per the current standard. So any question you will come across in the exam, they won't give you this fair value. They won't give you. It was there before they revised the standard. But now when they revised, these lease payments, you normally consider what you call what their present value, so that you can get what the lease liability. So in the current situation, if this question ends up having to come and they bring such kind of an item, then they'll never give you, in this case, what the fair value. It means you have to compute the fair value of this what lease by having to, in this case, do what? Get the rental payments multiplied by the present value interest factor of annuity, like that, so that you can be able to get what? The lease liability. You can be able to get the lease liability like that, the lease liability like that. So of course, you've already been able to get the right of use of the asset. What is actually now remaining is for us to, in this case, recognize the non-current liability and of course what? The current liability in the lease liability. So this lease liability you've actually been able to calculate. We should be able to know what is the non-current element of it and what is the current element of it. So that in this case, you can also, in this case, consider it what? In the statement of financial position. So what you need to do, remember, schedule, you come up with an amortization schedule like that, an amortization schedule like that, whereby now in this case, you likely consider the years, you likely consider the years. Then in this case, if they're having to pay in advance, of course, you'll start with the balance brought down of the lease, Then if they're having to pay in advance, then payment comes immediately. There. Then of course, now in this case, it will remain, there'll be the balance due after payment. Balance due after payment is when now you consider what? Interest on it. You consider interest on it. Then now in this case, you'll have the balance carried down at the end of the year. Because now in this case, we are only focusing on the year 2016. And of course, this lease was actually for 5 years. Of course, you want to do for all the 5 years. We just consider 2 years. So that in this case, you can only be able to get what? The element of the non-current liability and the current what? Liability. So we'll just do for 2 years. So that is end of 2016 and of course, end of 2017. End of 2016 and of course, end of 2017 to know in the financial statements of the year 2016, what will we consider as a non-current liability of this lease liability and the current liability of this what? This lease liability. So of course, now in this case, you'll have just 2 years. So the 2016 and of course, 2017. So from those two, we can be able to identify the current liability element for this year and the non-current liability element for this year. So we want to do for all the 5 years. But remember, in this case, under leases, we were having to do for all the years so that we can be able to come up with the extracts. But now we'll just do for 2 years because our main focus of the financial statements we are preparing, it is for the year 2016. So therefore, in this case, so we're having to, in this case, commence with a lease liability of 418. So of course, you've already been able to settle 132, so we are not having to make any payment there. So the balance due here is actually 418 the first year. So remember, the 132 had actually already been paid in advance. So we are not paying anything here immediately. So the lease liability is actually 418. Then the balance due once we make the payment is 418. Interest is actually at 10%. So 10% of this, you get 41.8. So that is averagely 42. You can just say put 40, averagely 42. Then you'll have the balance carried down. So the balance carried down, it means you take the balance due, you add on the interest. It will accumulate, and by the end of the year, you'll basically, in this case, be claiming from you how much? 460. So this one ends up having to be the balance brought down the next year, 460. But now here, we'll start by having to pay 132. Because those are the lease payments you're having to pay. So if you take 460, you minus the payment, you'll get 328. So this one minus this one, 328. Then the interest, you calculate 10% of this on the amount due. You'll get averagely 32.8, which is actually 33. Then in this case, you'll be able to get 361 as the balance. So in any case, you are continuing, would have put here the balance and we continue with the cycle like that for the next 5 years. For the next 5 years. For the next 5 years. So we won't consider, Valerie won't consider this one because they have already settled it in advance. Remember, the lease liability you've actually been able to compute here is actually of how many years? 4 years. In the initial year, they have already been able to pay. When they were having to start, they have already been able to pay 132. So we've already been able to minus the lease liability for the first year to get the 418. So it is not there. It is not there. So in this case, what we still have as a balance, we are supposed to be able to settle as you are starting. Remember, they are paying as they start. So it means you are opening with a lease liability of 418. So you're not making payment there. So we'll be able to make it in the next year as we are starting the next year. So that's why in this case, we will not have any payment here because this lease liability here, we've already been able to compute here. They have already made a payment of 132. They'll only be able to make the other payment the next year, which is 132 the coming year, the second year here. Because the 132 they have already been able to pay. So it is not included here. So we won't end up having to minus it. We won't minus it. So in this case, it will likely be like this. Then you'll be able to get all those balances. You'll be able to get all those balances. So from these now, you should be able to identify the non-current liability elements, non-current liability element of this lease liability, and of course what? The current liability element and the current liability element. And of course, if you can be able to recall, you can actually be able to recall. So for the non-current liability element, you'll actually be able to take the balance due. You'll take the balance due the second year. You'll take the balance due the second year. For the current liability, you'll likely end up having to take the payment that was done the second year. Payment that was done the second year. Payment that was actually done the second year. So the balance due the second year is actually how much? Is actually 361. It's actually 361. No, it is 328, sorry. The balance due is actually 328. So it means our non-current liability with regard to this lease that we'll be able to take to the statement of financial position will likely be 328. Then the payment the second year, what we've been able to pay is actually 132. So this is what they're having to claim for us to be able to pay in that year immediately, is actually 132. So in this case, we'll be able to recognize this one as a current liability, this one as a non-current liability. So this one they are still having to pay. They'll pay like for the next 5 years. So it is non-current. It is non-current. But what they're having to pay immediately with regard to this lease, they immediately pay how much? 132. So it is the current liability. They are called upon to make a payment of 132 immediately. But this 328, it is long-term. So they won't pay it immediately. So in this case, we'll be able to recognize 328 as what? As our non-current liability. Don't forget this particular formula here. It is very essential. When you have, in this case, the amortization schedule, to get the non-current liability element of, in this case, what? The lease liability, you take the balance due in the second year. For the current liability, you take the payment that was done in the second year. The payment that was actually done in the second year. So you need to remember these figures. So non-current liability of 328, and of course, what? Current liability of 132 with regard to what? The lease liability. So when we'll be coming up with the statement of financial position, we'll have to add those particular two figures regarding what? This particular lease. That's basically how, in this case, you end up having to deal with that one, with this particular lease liability. So we can go to the next one. That is working number 3. So sometimes they can bring in the lease issues, but it is rare, but it can be there. You never know. It can be there. You never know. It can be there. You never know. So, but it is very rare they bring in the lease elements in the published financial statements. So the next item in this case you're having to deal with is what? Depreciation. Depreciation. So plant is depreciated at the rate of 15% per annum using the reducing balance method. So depreciation of plant or plant. So they are using the reducing balance method. So if you look at, in this case, the plant at cost. So plant at cost is 936. The accumulated depreciation, it is at the end there, the last figure, 156. They are depreciating at the rate of what? 15%. So you do the computation. What do you get? 936 minus 156. The 42. So it is correct. This is Valerie. So that is Valerie there. So this 42 here, where is it? Where is the 42? So the 42 here this particular interest here, we'll include it in the finance cost. We'll include it in the finance cost. So you will add it here. We'll be able to add it here. When you'll be getting the finance cost, we'll take this one and of course also this one. So I had forgotten to explain that one. But that is correct, Valerie. So we'll take this one and of course add on to this one to get the finance cost during the year. So it is correct. So what you get 936 minus 156 by 15%, you get 700 and by 15%, you get 700 and 117. Yes, 117. 117. You get 117. But you need to take note of what you've actually been told about it. It should be included in what? In the cost of sales. So that's why we didn't do the figure for cost of sales, because there are these kind of elements that are there. Then land and buildings were revalued on 1st of November 2015 at 600 million and 1050 million respectively. So of course, in this case, we have what? Revaluation. We have revaluation, land and buildings. We have revaluation, land and buildings. So if you look at the trio balance, the value of land is actually in this case 400. But of course, it was revalued up to 600. So it means there was a gain, there was a revaluation gain of, in this case, how much? 200 million. A revaluation gain of 200 million. Then the buildings you are told, after revaluation, the buildings were estimated to have a useful life of 35 years. So the buildings were revalued up to 1050 million. But remember, the buildings have what? An accumulated depreciation of how much? 360. So in this case, the buildings, of course, they have a cost of 1200, but they have an accumulated depreciation as you're having to start the year. They have an accumulated depreciation of 360. And therefore, it means as you're having to start, it is 840. So the value of the building is actually 840. It is 840. But now they revalued it up to 1050. So it means there was a revaluation gain of, so the value of the buildings at cost is 1200, but already as you are starting the year, there's an already accumulated depreciation on it. So the net book value at this particular point in time, it is 1200 minus 360, you get 840. But they revalued them up to further 1050. Revaluation gain of how much? Nekesa, 210. 210. And therefore, in this case, we have a revaluation gain of 410. Hiyo tumesema itaenda wapi? Itaenda kwa revaluation reserves. And of course, also in this case is what? Is a gain. You can be able to include it as what? As other incomes in the statement of what? Income. So that will end up having to, in this case, go to the reserves. It will go to the reserves. It will likely go to the reserves. It will likely end up having to go to the reserves. It will likely go to the reserves. But now, there's something you are told there about depreciation. After revaluation, the buildings were estimated to have a useful life of 35 years. After us being able to revalue up to 1050. So they'll stay there. They'll be there for the next 35 years. So it means we have to calculate depreciation for this current year. So depreciation, this was land. You can be able to indicate this was land. This is buildings. This is land. This is buildings. You can be able to indicate so that you don't forget. This is land. This is buildings. So depreciation on, in this case, what? Buildings. So you take, in this case, their value now, you divide by the useful life, 35 years, you'll get what? To get the depreciation for the current year, 1050 divided by 35. Current Paul, 1050 Augustus, 1050 divided by 35. Because they'll be there for the next 35 years. We have to get depreciation in the current year. You'll be able to get how much? 30. You'll get 30. What have you been told? So after the evaluation, the buildings were estimated to have a useful life of 35 years with nil book value at the end of their economic lives. At the end of their economic life. economic life, at the end of the economic life, at the end of the economic life, at the end of the economic life. Have we been told where we are supposed to place this depreciation? Have we been told where we're supposed to place this depreciation? Of course, in this case, for plant, we are told you are supposed to place it where? In the cost of sales. This one, have you been told? Land and buildings were revalued on 1st of November 2015 at 610.50. After revaluation, the buildings were estimated to have a useful life of 35 years with nil book value at the end of what? The year? At the end of the economic lives. We haven't actually been told. But now in this case, what you'll do, you'll actually end up having to do what? Place it under the cost of sales. You can be able to place it under the cost of sales. You can end up having to place it under the cost of sales, under the cost of sales. And I think ideally those are the computations. Those are the computations. So we have in this case what? Tax. The corporate tax for the year ended 31st of October 2016 was estimated at 169.8 million. The deferred tax provision as the end of the year was actually in this case 84.6 million. 84.6 million. So we can in this case compute the income tax expense. We can be able to compute the income tax expense. So income tax expense. Income tax expense normally comprises of current tax, which you've actually been given as 169.8. 169.8. We have to add on or less. So the deferred tax, it will depend if it is actually an increase or a decrease. So of course, this deferred tax you've actually been given here of 84.6. It is the deferred tax at the end of the year. If you look at the TO balance, there's another deferred tax you've actually been given. There's another deferred tax that you've actually been given of an amount of 75. That deferred tax in the TO balance is the deferred tax balance at the start of the year. Is their deferred tax balance they're supposed to have settled at the start of the year. But it means in the current year, this deferred tax has increased up to 84.6 million. So in this case, there's what? An increase. There's an increase in the deferred tax. So 84.6 minus 75. You get what? 9.6. 9.6. It is an increase. This was at the start of the year. This is at the end of the year. During the year, it has increased by 9.6. So if it's an increase, you add on the tax expense. You add on the tax expense. So you should be able to add. You'll get 178. This is 4 point. This is 4.9. So 179. 179.4. So this one will be the income tax expense, which will be able to take to what? Statement of income. We'll take to the statement of income as the income tax expense. As the income tax expense. In any case, it was a decrease, would have minus. In any case, it was a decrease. Let's say, for example, in this case, you are told that the deferred tax by the end of the year, it was in this case 60. So it means it would have been a negative. We would have taken 60 minus 75. It would have been minus 15 here. So if it's a decrease, you less. If it's an increase, you add. If it's actually an increase, you end up having to add. So sometimes they can tell you the balance by the end of the year was actually maybe the lower amount. So that means it decreased. If it's a decrease, you end up having to do what? Deduct. If it's an increase, you add on the income tax expense. By taking the current tax figure, you add on what? The deferred tax increase or maybe decrease. You'll end up having to deal with it like that. You'll actually deal with it like that. So we can now, in this case, look at the other key figures. There are just two key figures that in this case we must be able to come up with there. The other two key figures that we must actually be able to come up with. It is the cost of sales, and of course, the figure for property, plant, and equipment. So the cost of sales. So how do you get the cost of sales? You take the opening stock. Of course, this one you'll end up having to get it in a TO balance, and you've actually been given a figure of the opening stock is there. It is in the TO balance. It is 226.8 million. 226.8 million. You can add on purchases. add-on purchases. Still, this one you'll be able to get it in the TO balance. You've actually been given a figure of 469.2. 469.2. You less closing stock. Less closing stock. This one, obviously, it is normally in the additional information. You've actually been told there's a figure of 259.2. 259.2. So this one you less. But of course, the other items which you've actually been called upon to add on what? On the cost of sales. For example, depreciation on what? On a plant. Depreciation on plant. Depreciation on plant, which is there, 117, 117. But remember, we had another plant. This one that was actually leased. It was how much? 110. Remember, plants are two. We have this one that was leased, and you have this one that they already have theirs. It is 117. Then, of course, you have the list on the list plant. On list plant, it is 110. Then, of course, we've been able to also say we can be able to consider that one on what? On buildings. So depreciation on buildings. It is in this case 30. It is actually in this case 30. So what do you get? You need to do the computation. What do you get? What do you get? Augustus. So opening stock plus purchases minus closing stock. You add on depreciation on plant, depreciation on the leased plant, then on the buildings. Nekesa, what do you get? 693.8. 693.8 million. So that's in this case what? The working for? That in this case it was working 6. Working 6. So we can do working 7 for property, plant, and equipment. Property, plant, and equipment. So for property, plant, and equipment, we can do working 6 for property, plant, and equipment. Property, plant, and equipment. So of course, the properties we have here, we have in this case land. We have in this case land, which is here. And of course, you have in this case what? Buildings. You have in this case land. Land. So land, the value in this case is actually 600. It is this one. It was revalued. Is actually in this case 600. We have in this case buildings. So buildings, we have in this case buildings. Of course, for buildings, we have 1050. It was revalued still. 1050. We have in this case land, buildings, and of course, what? Plant. We have in this case plants. We have plant. So for plant, we have we have in this case 936. So for plant, in this case, we have 936. 936. We have 936. 936. But of course, there were depreciations. Like in this case on buildings, is that depreciation we've been able to calculate. It is 30 after revaluation. Remember, in this case, when they revalued them, they came up with a new depreciation policy. So when they revalued them, they started in this case with what? A new depreciation policy. So in this case, it is actually what? 30 depreciation on buildings. On buildings. That was the new depreciation policy moving forward. So in this year, they have depreciated what? 30. But now, of course, also you have a depreciation on plant. Depreciation on leased plant. On leased plant. We were getting how much? Is it 110? So of course, this one we'll be able to consider it in what? In the rights of use of the asset. So we won't put it here. So we won't put it here because we'll consider it in the right of use of the asset. So this one we won't put it here. It won't affect here. It will affect this one. When now we'll actually basically be placing it as a non-current asset. We'll take 550 minus this one. So it won't affect our PPE here. So this one will be recognized separately, not amongst what? The properties, plant, and actually what? Equipment. But now in this case, you have depreciation on what? On plant. Depreciation on plant. Depreciation on plant. On plant. On plant. So of course, you already have in this case, the one that was there, it is 156. 156. But of course, for this year, we've actually been able to calculate it is 117. 117. When you add the two, what do you get? Remember, this was the accumulated at the start of the year. By the end of the year, we've added onto it. So it is 156 plus 117. What do you get? 156 plus 117. 156 plus 117. You get 273. You end up having to get 273. So you less. Then in this case, you should be able to get the figure for PPE. So you can do the mathematics. So add 600, 1050, 936. Depreciation on buildings, which is 30. It was after evaluation. Then in this case, on plant, we have to take the two of them. The one that was accumulated at the start of the year, then the one at the end of the year. You get 273. You'll get, in this case, 2283. 2283. 2283. And of course, that is basically the figure we'll be able to take the statement of financial position as what? As in this case, what? Property, plant, and equipment. The rights of use of the assets will recognize it separately as an non-current asset. So it won't actually end up having to come under what? PPE, because it is not, in this case, ideally their asset. They have actually listed. So we have to, in this case, account for it separately, as to why, in this case, you are required under what? The relevant standard for leases. So the right of use of the asset will take 550 now minus 110. We'll be coming up with what? The statement of financial position. So of course, those are actually our workings. And of course, we can, in this case, come up with what? The statement of income. Then we try to get the statement of changes in equity. Then, of course, now in this case, eventually, the statement of financial position. So hope you are through with having to write, because I'm going to rub. I'm going to rub. Are you through? Missy. Is it Missy in this class? Are you through? Augustus, are you through? Are you through? Irene, yes. Augustus, done. Anthony, Andrew. Yeah, so I think it is okay. So we can now, in this case, prepare now those statements. We have, in this case, Peak Limited. Peak Limited. It is statement of profit or loss, or income statement. I've said income statement. Income statement for year ended. For year ended, it is 31st of October. 31st of October 2016. 31st of October 2016. So our shillings are actually in millions. Our shillings are actually in millions. So automatically, in this case, we start with what? With the revenue. So revenue doesn't have any form of adjustment. So some of the figures won't have adjustments. So these are the ones you are saying you can be able to just scoop the marks without having to sweat a lot. But now, in this case, the problem with published, some of the elements you won't end up having to know unless at least you've gone through the workings. So for example, this one sometimes has adjustments, but rarely it'll have, but it can have. So you can't assume you'll just take the figure as it is. Sometimes, but not always. In this case, it can have what? An adjustment. But now in our case, it doesn't have. Then we less what? The cost of sales. We less the cost of sales. Of course, this one, you have to do the working. I don't know it is working number what, but there's a working, which in this case, we've actually been able to get the figure for the cost of sales. It is how much? The cost of sales it is coming to, the cost of sales is coming to 693.8. 693.8. So you can be able to less, so that in this case, you determine what? The gross profits. We determine the gross profit. We determine the gross profit. So what is the gross profit? Gross profit is how much? 976.6, 976.6, 976.6, 976.6. We can in this case consider any other incomes before we less the expenses. You look at on the credit side of the tier balance. So we have revenue, we have ordinary share capital, we have income from investment. So that is an income. That is, we have retained earnings, we have debentures, we have dividend, account payables, we have bank overdraft, we have deferred tax. So there's that investment income. So there's that investment income of how much? 27. So other incomes. We have in this case investment income, which is 27, which is actually 27. Then now we can be able to consider the expenses. We can consider the expenses. So the expenses here, we're having to say you'll have admin. In most of the questions, you'll have admin. We have selling and distribution. So admin expenses, we have distribution expenses. Distribution expenses of 33. Of course, this one you're having to less, 33. We have admin expenses. They don't have adjustments, this one. So you just pick them as they are. It is actually in this case, so distribution expenses is 60. This one is 60, sorry. Distribution expenses, this one is 60. It is actually 60. Distribution expenses is actually 60. This is the one that is actually 33. 33. This one is 33. Then we have in this case what? Finance costs. We have finance costs. Finance cost, remember what Valerie was having to remind us. There's that particular interest on the lease liability, which is actually 42. Then we have in this case interest on the debenture, which is actually 20. So in this case, it will come to 62. It will actually be 62. 62, that is the finance costs and finance costs. So we'll in this case get what? The profit before tax. Profit before tax. Profit before. So take note, these are like the standard items you'll be able to get in the published income statement. So you'll have revenue, cost of sales, distribution, admin, finance costs, then eventually you'll go to profit before tax. Sometimes this one can be there or it can miss out. But these ones, you won't miss them. This one, this one, this one. In an exam situation, it has to be there. So these ones, in most of the instances, you'll do some adjustments to them, like the same case you've done to cost of sales. Sometimes you can be told 40% of depreciation will go to distribution. 30% of depreciation will likely go to admin. So if that is the case, you need to come up with a statement of the expenses, statement of expense, whereby in this case, you'll be able to have cost of sales in one column, you have admin in another column, you'll have in this case distribution in another column. You can even have finance in another column. For example, if you had come up with this particular statement here, then for finance, we would have been able to say interest on lease liability, 42. Then we'll also say in this case, so because it is not here, it is not in these ones, then we would have also been able to say interest on debenture, we add on it, so it is 20. So it means when we come up with the total figure here for finance cost, it would have been 62. So the items we've been able to adjust for cost of sales, we would have placed them here. We would have said in this case, maybe the figure for the cost of sales as per the trio balance, we would have been able to take the opening stock plus purchases minus closing stock. That figure we get, we can be able to put it as what? As the opening balances. As the opening balance is what? For cost of sales. All right, alternatively, you can just place all those items. You see how in this case, we've been able to categorize them under cost of sales going down. So they would have come in this column, all of them. Sometimes you would have been told that if depreciation on plant, 30% will go here, 20% will go here. Then in this case, maybe 50% will go. You have to apportion them. Then you add them to be able to get what? The statement of expenses. Statement of expenses. Then once you've been able to get these figures, are the ones you'll be able to come and just be able to plug them here. Plug them here, plug them here, plug them here. Take note, we are insisting. Don't come here and start having to say for the cost of sales, opening stock plus that working you've done separately. Don't bring it here, Andrew. You won't get the mark. You won't get the mark. You have to do it as a separate working. The admin expenses you also do as a separate working. Then you just place the figure here like this. You just place the figure here like this. You don't end up having to place them here. So you can be able to get the profit before tax. What is the profit before tax? What is the profit before tax? PBT is 848.6. 848.6. 848.6. 848.6. So take note, if you have something like in this case, revaluation gain, you can be able to add it here as what we call what? Other comprehensive incomes. Other comprehensive incomes. You add it here as other comprehensive incomes. So the other comprehensive incomes we have is the revaluation gain. Is the revaluation gain, which is actually in this case an amount of 410. An amount of 410. And therefore in this case, the total comprehensive income, total comprehensive income will be when you add the two. Will be when you add the two. I can see you're not seeing there. I can see you're not seeing there. So 848.6 plus 410, you'll get total comprehensive income. Total comprehensive income, you'll get total comprehensive income. You get total comprehensive income, which comes to 1258. 1258.6. 1258.6. So we can go now in this case to the statement of changes in equity, because that is what you've been called upon. So part B is this peak limited. Peak limited. You're able to see there. So peak limited. So statement of changes in equity. Statement of changes in equity. As at, it is for the year ended. It is for the year ended. For year ended 31st of October 2016. So you have to, in this case, identify the equity items you have in this case in what? In the TIO balance. Of course, the equity items you have in the TIO balance, you have to identify them. You have to identify them. You have to identify the equity items you have in the TIO balance. You have to identify the equity items you have in the TIO balance. So for example, in this case, you have ordinary share capital. We have in this case retained earnings. We have retained earnings. We have retained earnings. We have in this case what? I think there are those one. Ordinary share capital, retained earnings. Sometimes there can be share premium. There can be share premium. There can be preference share capital. But for our case, we only have ordinary share capital and retained earnings. But now there's another item which we got along the way in our computations. Revaluation gain. Revaluation gain. Revaluation reserve, sorry. Revaluation reserve. Remember, I told you this revaluation gain will go to the revaluation reserves. To the revaluation reserves. And therefore, you can start with the opening balances. Opening balances. Opening balances. The opening balances, you normally get them in the TIO balance. You normally get them in the TIO balance. You'd be able to see them in the TIO balance. For example, in this case, for ordinary share capital, it is 900. It is 900. Yet it is 900. It is 900. For the retained earnings, at the start of the year, it was 717. 717. In this case, for the revaluation reserve, we haven't been given an opening balance for this one. So it is dash. It is actually dash there. It is actually dashed there. Then you look at any items that will end up having to affect these ones. That will likely end up having to affect these ones. That will likely end up having to affect these ones. So this ordinary share capital, in most of the instances, it will be affected, for example, if there were extraordinary shares that were issued during the year. So it means the ordinary share capital would do what would increase. So if the examiner ends up having to bring about a story regarding during the year some shares were issued, automatically what should be ringing in your head, the ordinary share capital in the statement of changes in equity, you have to adjust it. Even if you haven't been told to prepare it, the figure for ordinary share capital that will basically go to the statement of financial position has to be adjusted with the extra what? Capital. So of course you haven't been told such kind of stories here. So there's nothing in this case you're having to see that is likely to affect this. But now we have the retained earnings. For the retained earnings, there's that profit we realized during the year. There's that profit for the year. That profit for the year. The profit for the year, you'll pick this particular figure here because this one will likely go to the revaluation reserves here. So in this case, it will likely be 848, 848.6, 848.6, 848.6. Oh, there's something we forgot here. You people are not having to tell me. Income tax expense. You people are not having to tell me. The income tax expense was how much? The income tax expense was how much? Yes, I can see you are telling me, Mwalimu, are we not deducting? So I had forgotten. It's supposed to be there. It was how much, the income tax expense, Valerie? It was 179.4. 179.4. So sorry about that. 179.4. So you less so that you can be able to get the part. So here you'll get what we call what? Part. You'll get part. So the part here will be how much? The part there will be how much? The part there will be how much? It will be when you minus. So remember, profit before tax, you have to less the income tax expense that we computed. In our working number, is it 5 or maybe 4? So the part is 669.2. So the part here, it is 669.2. So you can be able to correct. Then the 669.2 is when you can be able to add this for 10. Is when you can be able to add this for 10. So hope you are able to make the adjustments. Maybe let me just do it as it's supposed to be. So you have in this case the income tax expense. Income tax expense, that is 179.4. So when you less in this case, you'll get 669.2. That is the profit after tax. Profit after tax. Then we'll have in this case other incomes, other comprehensive incomes. Other comprehensive incomes. In this case, we'll have here the revaluation gain. Revaluation gain of 410. Then when you add, this is 2, this is 9, this is 7, this is 10. So 1079.2. 1079.2. So in this case, it means our figure for the profit for the year will likely not be 848. It will likely be 669.2. So 669.2. 669.2. Then during the year, of course, from these retained earnings, they paid somewhat dividends. So dividends paid, it is in the TO balance. Dividends paid, they paid some dividends out of the retained earnings after tax. Those are dividends that was actually paid of 90. Probably it was maybe an interim or something. They had actually paid a dividend of 90. So you less. Then of course now in this case you have what? Revaluation gain. Revaluation gain. So this one basically will go to the revaluation reserve. It is of an amount of 410. 410. So with these kind of adjustments, then we can be able to get our changes in equity, and we can be able to know what are the balances at the end of the year. So these are the closing balances. These are the closing balances in regard to ordinary share capital, retained earnings, and revaluation reserve. Those are the closing balances. So here it is 900. This one is 900. This one is 410. What about this one? 717 plus 669.2 minus 90. Minus 90. Minus 90, you get Ruth. 717 plus 69.2 minus 90. You get 1296.2. 1296.2. And of course, that is what our statement of changes in equity. That is our statement of changes in equity. 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 So it was how many marks? It was 4 marks. It was actually 4 marks. So it means you must have been able to get here, you get here, you get here, you get here, you get here. So those 4 you would have been able to score your 4 marks. Your 4 marks. Then this one was actually 8 marks. This one was actually 8 marks. It means it was this one, this one, this one, this one, this one, this one. We have 1, 2, 3, 4, 5, 6, 7. I think 8. I think 8. So you would have been able to score your 8 marks. You would have actually been able to score your 8 marks. You would have actually been able to score your 8 marks. 8 marks. So that's it. So we can now, in this case, finalize by having to look at the statement of financial position. Statement of financial position. So we can be able to finalize by looking at the statement of financial position. So Peak Limited statement or financial position as at 31st of December 2016, 31st of October 2016, 31st of October 2016. So you can have in this case our shillings in millions. Our shillings in millions. You can have our shillings in millions. So of course we can automatically start with the non-current assets. Non-current assets. So the non-current assets, automatically we start with what? Property, plant, and equipment, which we did as a working. And in this case, we got a figure of what? We did as a working. We have right of use of the asset. Right of use of asset. With that plant that was actually leased. So of course, the right of use of the asset was actually in this case, we got 550, but it lost value by 110. And then it means we have in this case 440. This one is 2283. 2283. So I think we got that particular figure there, 2283. So the right of use of the assets for the leased plant, because in this case, it normally comes to appear as what? As a non-current asset. So when you're dealing with leases, you have to calculate what? The right of use of the asset by taking the lease liability and add on any advance payment on the commencement of the lease, and also add on any cost that was actually incurred to facilitate the use of that leased asset. So it will basically come to what? The right of use of what? Of the asset. So like that. Then we can also in this case be able to consider any other non-current asset you can be able to see. You just look at the debit side of what? Of the trio balance. Land and buildings, plant, PPE, purchases, distribution, administrative loan, interest paid, lease, plant, rentals. So that's what they were having to pay as 132, which you have actually computed there. We have inventory. We have accounts receivable. We have long-term investment. Long-term investment. We have long-term investment of 540. 540. Long-term investment of 540. So you can now in this case go to the current assets. So current assets, automatically we have what? Inventory, which you are given in the additional information. It was 259.2. So this one doesn't have any form of adjustment. Just comes the way it is. We have trade receivables, which have actually been given there also. It doesn't have any form of adjustments. Accounts receivables. It is a figure of 327.2. I think we have been told also cash in hand. There's a cash in hand of 2. There's a cash in hand of 2 million. Cash in hand of 2 million. Always check on the debit side of what? The trial balance. If there's any other current asset you haven't been able to consider. Inventory we have considered. Accounts receivable we have actually considered. Cash in hand we have actually considered. There's no any other item that in this case is actually there. So you can go to the side of equity and liabilities. Equity and liabilities. You can go to the side of equity and liabilities. So of course you can be able to add. So we have in this case equity and liabilities, equity and liabilities, equity and liabilities, equity and liabilities, equity and liabilities. So because you have our equity items which you've already been able to compute there, we have in this case ordinary share capital. We have in this case retained earnings. Then of course you also have in this case revaluation reserves, revaluation reserves. So ordinary share capital, it is 900. For retained earnings, it is 1296.2. Then for our revaluation reserve is actually 410. It is actually 410. There's no any other equity item. So we go now in this case to non-current liabilities. We go to non-current liabilities. Non-current liabilities. So of course, automatically we have what? 8% debentures. 8% debentures. Which in this case it was of how much? 300. It was of how much? 300. So which other item will we put there? Which other item are we going to put there? Current poll. Which other item are we going to put there? Which other item are we going to put there? The lease liability of how much? The lease liability of how much, Valerie? Lease liability of how much? The lease liability of how much? 328, 328, 328, 328. So I can see, Valerie, you are saying 132. Can see, Valerie, you are saying 132. Ruth, is it 328 or 132? 132 is what? 132 is the current. Sawa, Valerie. 132 is the current. But now for the non-current, we take that other one, which was 328. So exactly 328. Then what else? What else? Current Paul, what else? What else? Andrew, what else? Apart from the lease liability? Apart from the lease liability, what appears here? DT. Don't forget deferred tax. Those are the figures I've told you. They'll end up not having to have any form of adjustments. Those ones is like it is automatic. You just pick what you've actually been given in the additional information, which in this case is how much? 84.6. 84.6. Then always be able to check on the trial balance on the credit side. If there's any other item of non-current liability you haven't included, for example, there can be a long-term loan, which you have not put there. You always need to be able to check on the credit side of what of the trial balance. So because you have bank overdraft, those are current, but now you have only what in this case? So So there's no any other item. So in this case, always check on the credit side of the trial balance. Then you can have the current liability. So of course, the first one we've already been able to tell us lease liability of 132. 132. So it's a lease liability of 132. Then in this case, you have what? Current tax. Also, this one I told you, rarely it will have adjustments. This one you just pick as you've been given in the additional information. It was current tax payable. They were yet to pay it. So it is a liability. So in the current tax in this case was how much? 169.8. Then you have in this case what? You can check there's a bank overdraft, which you've just mentioned a while ago. A bank overdraft in the trial balance of 20.4. Then the other item is accounts payables. Accounts payables of 202.4. Accounts payables of 202.4. But now there was another item of interest. Interest accrued. There is interest accrued. Interest accrued. There was an interest accrued which we did in working one. We did in working one. It was coming to 8. It was coming to 8. So you can add. You can now add. You can now add. You can now add and then give me the total figures. You can now add and give me the total figures. I can see 385. 385, 1.4. Karen Paul, confirm that figure. Confirm that figure. Confirm that figure. 385, 1.4. 3851.4. Karen Paul, confirm that figure, or any other person. Confirm Irene's figure. At least 2 or 3 people should be able to give the same figure for us to be confident that the addition there is okay from Irene. At least 3 or 2 or 4 more people should be able to give that as that figure for us to say in this case indeed it is as how she has been able to add there. Can see Kantha. So 3851.4. So both sides, 3851.4. It should be both sides. Irene, confirm it is both sides. 3851.4. 3851.4. And of course, that is how you would have been able to deal with that one. How you would have been able to deal with that one. So before we wind up, I want us we look at another one. But we won't delve into deeper details. I'll just be able to take you through the additional information. Then I think we'll be able to look at it comprehensively. I want us we look at another one. Because this published, you have to score 15 and above. You have to score 15 and above. To be safe, you have to score 15 and above. This published, you have to score 15 and above. Published, you have to score 15 and above. So I want you to open another question. So I'll just be able to take you through the additional information. Then I think we'll be able to look at it in our next class very fast. We'll be able to look at it. And I think we'll also be able to, in our next class, we'll also be able to revise on leases again. We will revise on leases again. So of course, you've been able to come across leases in this particular question we've done. But after being able to look at that published question, we'll also look at another question on leases. Then I think after that, we'll go back to group. And do another, I think one question. Before now, in this case, we now delve into the other areas. So we'll finalize on published with this particular question we're going to do. Then we'll do a question on leases. Then we'll go back to group. Then I think after that, we'll be able to look at other areas. We'll be able to look at other areas. We'll likely be able to look at other areas and see what will happen So it is November 2015. November 2015. It is question number 1. November 2015, it is question number 1. November 2015, it is question number 1. November 2015, it is question number 1. So confirm whether you've been able to open that question because you want to wind up the class. We want to wind up the class. Duncan Otila, do you have that question? November 2015, question number 1. Kindly open that question. Debbie has already gotten it. What about Andrew? What about Augustus? What about Anto? So I can see you are saying yes. Anto says yes. So we can go through it. It says, Dollar, a quoted company dealing in household goods, has prepared the following trio balance as of 31st of December 2014. So you've actually been given the revenue. There's a loan interest that was actually paid during the year. We have purchases. We have distribution costs. We have administrative expenses. We have an interim dividend that was actually paid of 6. We have inventory at the start of the year. That is opening stock. Then you have, in this case, trade receivables and trade payables. You've actually been given the figures there. We have cash and cash equivalents. That is a current asset. We have ordinary shares at 10 shillings each. That is an equity item of 100. We have share premium, an equity item. We have general reserve, an equity item. We have retained earnings, an equity item. We have 10% loan payable. That is an uncurrent liability. It is payable in 2024. That is an uncurrent loan. So it is payable in 2024. Then land and buildings at cost and of course what accumulated. Of this value, 60 million is the value of land, while the remainder is actually what? Buildings. So you have to take note of that. Sometimes in this case, they'll call upon you to do what? Calculate depreciation on buildings. So it means you won't take it on 380, but it will be what? 320, because the value of buildings here, it is 320 if you minus the value of land. Land, we don't depreciate. So plant and equipment at cost and accumulated. Investment property, that is an uncurrent asset. They got some rental income and there were some proceeds from sale of equipment. It means during the year, maybe they sold what? An equipment. They must have sold an equipment. So if that is the case, probably in this case, we'll be calculating the loss or gain on disposal. So you are told closing inventory as of 31st of December 2014 amounted to 388 million at cost. However, shortly after the year end, some inventory with a cost of 15 million was actually sold for 8 million. So that is a situation whereby now in this case, you'll have an adjustment on what? On the closing inventory. Because you've been given what? Additional information. So of course, in this case, you're having to be told that the cost of inventory is what? The cost of inventory is actually in this case 388 million, the closing inventory. But included in these items, there are items which are costing 15 million, but ideally we can only be able to realize out of this how much? 8 million. You can only be able to realize out of this what? 8 million. So according to IAS number 2 on inventories, it actually basically states that inventory is measured at the lower of costs. Inventory is measured at the lower of costs versus the net realizable value. So it means these items of inventory here, which were included here, we have to less. So in this case, you have to say 388 minus 15, then we add 8. You have to less. You have to, in this case, less. Because now in this case, we'll value this inventory at the lower of the two. So how it was valued inside here, it is not correct. So because according to IS number 2, we normally value inventory at the lower of cost. The figure that is lower amongst the two is the one you end up having to pick. So we'll have to do that adjustment on what? On the closing inventory. On the closing inventory, we'll have to do that adjustment on what? On the closing inventory, on the closing inventory, on the closing inventory. And overall, it will also be able to affect what? The cost of sales. It will actually end up having to affect the cost of sales. So that is what will happen. So we'll have to say 388. We minus this 15 because it was not correctly valued inside here. But now we add on now the correct valuation of this 15, which is 8. Which is 8. Alternatively, you can be able to minus the difference between the two, which is 15 minus 8, which is 7. You can minus 7. You can minus 7 like that. You can minus 7. You'll be able to get the same. You should be able to get the same. I think 381. 381, yes. You should be able to get 381. 381. You'll be able to get the same. So that's what will happen with that note number 1. We'll adjust the value of inventory, and it will also be able to affect what? The cost of sales, because closing inventory normally affects what? The cost of sales. Land and buildings were revalued on 1st of January 2014 to 800 million. So including land at 100 million. So that's why in this case you can see, it means in this case you'll have what? A revaluation gain, and therefore eventually what? A revaluation reserve. Revaluation reserve. We'll have a revaluation reserve that will actually end up having to arise in that regard. There'll be a revaluation reserve that will actually arise in that regard. And of course, you also have to consider what? Depreciation, because now the useful life is actually 40 years. The income tax liability in the year was estimated at 20 million. Deferred tax was to be provided at 7 million. So you can be able to check whether in this case you have any deferred tax. Is there any deferred tax we have in the trial balance? I don't think we have. So that means in this case, our deferred tax will likely be 7 million. So by the end of it, it will likely be 7 million. And therefore, we'll be calculating the tax expense. We'll be able to add on a deferred tax of 7 million because it increased by 7 million. It increased by 7 million. Then during the year, the company sold some equipment which had cost 15 million with accumulated depreciation as at 1st of January 2014 for 3 million. An item of plant was also estimated to be impaired by 4 million during the year. So we'll have to come up with a disposal account to ascertain whether there was actually any gain or loss on the sale of what? This what? Equipment. Then depreciation rates are as per the company's policy. Buildings over its useful life. Plant and equipment 20% on reducing balance. The company's accounting policy is to charge full year's depreciation in the year of the asset purchase and none in the year of disposal. The company treats depreciation of plant and equipment at cost as a cost of sale, and on land and buildings as what? As administrative expense. You have to take note. When you come up with the depreciation for the two, you'll have to isolate them. So that in this case, you'll have for the land and buildings having to go to what? To administrative expense, and that one on equipment having to go to cost of sales. Then dollar limited values investment property at fair value. The fair value of investment property as of 31st of December 2014 was 586. I think we have investment property. Do you have investment properties? We have revenue, loan, purchases, trade receivables, land and buildings. There's an investment property, yes, of 548. So they did a revaluation. So of course that is what? Another revaluation gain. So it will end up having to go to what? The revaluation reserve. So it means in this case, what we'll be able to recognize as the value of this investment property at the end of the year will be 586. And therefore there will be a revaluation gain and a revaluation reserve there. During the year, the company made 1-for-3 bonus issue capitalizing in what? In general reserves. So they ended up having to do what? Issue extra shares. They actually issued extra shares. So we'll likely end up having to compute this bonus issue. A bonus issue is an extra issue of shares. In this case, what? The existing shareholders. So instead of them having to get dividends, probably they were actually told to get what? In this case, bonus or extra shares. But now they capitalized in what? In the general reserves. So we'll end up having to get these bonus shares, the amounts from the bonus shares. But now in this case, we'll likely end up having to capitalize them what? In the general reserves. We'll likely capitalize them in the general reserves. So we'll be able to use this one in what? In the statement of changes in equity. Then prepare in a format suitable for publication the income statement, statement of changes in equity, and statement of what? Financial position. financial position. So that's what we'll be able to look at in our class, in our next class, our subsequent class. So, but you can be able to try to do it on your own. You see whether in this case, at least you've understood something, or in this case, things have gone haywire, or things have gone haywire about what published financial statements. You can try to attempt it by yourself as an assignment over the weekend. Then when we come to class on Tuesday, we'll likely be able to go through it as you try to mark for yourself, for yourself, so that you see whether you have comprehended, or maybe things have gone haywire. Then after that, you'll be able to look at another question regarding what? Leases. You'll be able to look at another question regarding leases. Remember, in this case, you have lease payments in advance. You can read ahead. Lease payments in advance and lease payments in arrears. The most important thing, you must know how you compute the lease liability. How you, in this case, get the right of use of the asset. Another thing, how you come up with the amortization schedule. Remember, in any case, it is in advance or in arrears, the amortization schedule will look a bit different. So it will depend upon if exactly in advance or in arrears. The amortization schedules will look a bit different. But of course, now in this case, you have to know, after being able to prepare the amortization schedule, identification of the non-current liability and the current liability. Once you've been able to understand this, you are done and dusted. With leases. So how you calculate the lease liability, how you get the right of use of the assets, how you can be able to prepare an amortization schedule. From this amortization schedule, you need to be able to know how you identify the non-current liability and the current liability. And these ones also, you identify them differently, depending upon whether it is in advance or it is in arrears. So you see that thing I actually told you here? So it will depend. If it's actually in advance, it is different how you identify the non-current liability and current. If it is in arrears, it is different. So you have to be able to know. So once you're able to know these ones, then you'll likely be good to go with the leases. But of course, you'll be able to look at it in our next class so that you can be able to refresh yourself, because something is telling me there'll be a question probably on leases. There might be a question on leases. Otherwise, thank you very much. You can just start enjoying the weekend. Any question you might be having, you can be able to ask before we say ure to the class. So if there isn't, then I can just wish you a good night. So we catch up on Tuesday. Try to attempt that question as an assignment. Then when we'll be doing in class, you can be able to mark for yourself. So that's it. We meet on Tuesday.